Welcome to the Broken Pie Chart Podcast, episode 273. I'm your host, Derek Moore. With me once again is my semi-permanent co-host, CEO of ZEGA Financial, Jay Pestrichelli. Jay, I couldn't get Roaring Kitty on the program, so you're back.
All right. Well, I thought I was going to lose my spot, but he's now back in the market. But happy to tell everybody who knows this already, we hit a new high last week.
I'm shocked. Shocked again. You mean you can hit new highs after hitting a new high?
It's amazing. It's amazing. We've talked about that in the past that, after you get a new high, how often do you stay within the 3% range? We've talked about how often you hit a higher high after a new high. So yeah, great. That's, market had a nice, shook off that decline that we saw in the middle of April and a nice little run, right? From under 5,000 to over 5,300. That's nice.
Does Tom Lee need to change his year end? I don't remember what exactly his number was, but I feel like it was 5,200 or 5,300. Remember, Tom Lee's he's been bullish when other people haven't been. But does he have to raise it now? I don't know.
I hope he does.
Seems like he's been on the money versus some other ones. But
yeah.
Jay, I don't remember what our gentleman's wager was, which means we're not betting on anything. But what did I say? Was it 5,400 and you took the other side just for argument's sake?
I think I took the 4,900 and you took 54. You're getting close again. So you won the other one where you got to 5,150 first. That was great. And then the pullback. So I was you hit yours first and mine now. We got within, we got close. Getting close to 5,400, right? 53 and change was hit. So, this is, when you and I look at what's going on in the markets and the volatility markets, I think not everybody, but a lot of folks are saying smooth sailing till we start to approach the fall volatility around the election. So, running this one, a lot of folks are saying, and watch yourself in September, which, by the way, September is historically the worst month of the year. I think it's the only month out of the last 120 years that has averaged negative. It's an average negative 0.1. Every other month on average is positive, but September has negative. Although I would like to say, in my opinion, October has always had the biggest swings, but even though it's overall positive, it can also be a tricky one. But September, October, this is what a lot of folks are talking about. It's what you see in the options market. Even you can see volatility is projected to go up at that time. So look, this is right now we 12 handle on the VIX, volatility is low. I will still stand by I wouldn't be surprised to see a 10 handle on the VIX. We're not so far from that either. So this feels like the market's we've been through a lot of the news, right? We're going to talk about inflation data. We've been through a lot of the earnings, although there is a biggie coming up next week, and we'll talk about that too. So a lot of stuff is baked in. And so, look, markets just generally will have this tendency to go up. It doesn't mean it's run up straight, but it's been a nice little rebound. And I think you continue to call it one of the most hated bulls. Although
it is.
Yeah, I don't know. What's to hate? What's to hate? Can you get back to tell me what's to hate right now?
I think part of it is, and maybe it's because there were some people right about it. It's easier to go on TV and say everything's bad and we could have a pullback. It's safer. But I guess,
is it safer? I feel like it's wrong more than it's going to be right.
But they want that. They want the bad, but they want the doom and gloom.
It sells, right? I know the doom and gloom is eyeballs, but why would you not go up and be on TV and be like, hey, generally the markets go up? Because guess what? They do. It's why it works to invest over the long run, and you don't have to, day trade or swing trade to make it work, right? Buy and hold it. We hedge to offset some of the risks that can pop up as people are planning. But it would seem like the easier thing to do, go on TV and say market's going to go up. Why is it easier to say markets are going to go down? I don't know. I don't think it is, but they do.
Sam Rowe is someone who he has a newsletter and he put some stuff out on Twitter. And I think it was him that put out a phrase, the market made a new high. Think about all the bad stuff that has happened over the last 30 years in the world. And despite that, the market made an all-time high. Put that into context. It's a great point. Like markets generally go up over time. And yeah, I mean, if I went on CNBC at the beginning of the year and said, hey, there's a chance the market goes up 10%. I mean, there's a chance it goes down 10% too, but market goes up 10%, they wouldn't have me back. They'd be like, that's great. Thanks for telling us, that. No, they want somebody to go on there and be like, I don't know, this and that and this. And then when you see this, we could be looking at a 50% crash. It's, one of the things I'm going to do for a future episode, Jay, I'm going to go back to the archives and I'm going to try and pull up some stuff from 94 and 95 and see what bearish stuff people were saying. And we know what happened, 95, 96, 97, 98, now all the way to 2000, the market was really good. Like you said, we hedge. We don't know what's going to happen. Jay, you alluded to two things, though, and I think I have a bone to pick with Apple, by the way. I'm happy to share that.
Oh, let's hear it.
All right. So first, May 22nd, actually confirm the date for him, but NVIDIA's earnings are coming up, but then Apple is going to supposedly, or it's rumored they're going to announce some stuff around AI at their developers conference. I think that's the second week of June. Let me tell you what's wrong with, besides Siri is absolute garbage. I'm just going to be honest. I know you don't have an iPhone, but Siri as it can't do anything. Like you're like, oh, Siri, oh, by the way, I shouldn't say that because anyone who has Siri I might trigger their device here.
Yeah, do it.
Yeah.
Can you trigger the device?
I don't know.
Oh.
But yeah, I mean, I turn it off. I don't want it listening to me and it doesn't do anything. It's garbage. So they need to upgrade that. My other bone to pick with Apple right now on my iPhone, on the home screen, I live in Arizona. It's most of the time it's sunny, but it always has this thing, or it seems lately, severe weather. You know what the severe weather is? Like the air quality is 3 points above what's considered good. I'm like, really? Like severe weather is like a tornado's coming, a hurricane is coming. Like, can you imagine? Like, what am I going to do with air quality is 3 points above normal? Like, come on, Apple.
Stop breathing. That'll save the air quality.
All right. That's my rant. Fix that, Tim Cook. I sent them a note and they can't tell me how to do it. Oh. But Jay, back to the thing. Don't you think, I mean, these two events, maybe not the Apple Developers Conference, but NVIDIA last time was a big deal with earnings. Like, I feel like what they announce is going to make or break the market in the short run.
Look, we're coming up on the anniversary of that huge move they had, a year ago when they announced first, and all of a sudden they blew every number away, and they outperformed all highest expectations. And you're right about this is the darling stock now, or I think you mentioned it last week. Like just what NVIDIA does, it's driving so much. I would tell you, I think I speak to people. I speak to people who are NVIDIA fanatics, and their feeling is the stock can move in fits and spurts, and doesn't always have to kill it after earnings. You may get sideways for a little while, but generally they will surprise. So I don't know, Derek. I think if NVIDIA reversed what they were talking about, has the AI bump already helped everybody else and just kind of brought the rest of the market up? Like this move that we've had, this is a data point we should get, Derek. In the past we talked about the concentration, but the move that we've had, a lot of sectors have been participating in the most recent move higher. I don't think the market movement is relying as much in NVIDIA as you mentioned. Of course, I think it's a big deal, and it certainly changed the path of the market the last 12 months. But I think a lot of the financials are hitting highs. Utilities are hitting highs. Utilities, what is going on there? By the way, that's an AI play, right? Because I think there was a data point that came out. It takes, to do a Google search or an AI chat, it takes 17 times as much energy to produce the result of a chat versus a search. And so that is a thought that energy is going to be at a premium. So I don't know if you've looked at a chart of XLU, right? The utilities ETF. Wow, what is going on with that, right?
Oh, I mean, clearly should be trading it at an
Extreme, right?
800 forward multiple. No, you're not wrong, by the way. XLU up, XLF, like the easiest way to check the sectors. Type in any of the sectors, they're all up.
Yeah,
International's up. They're all,
right. Everything's
it's broad.
participating in this, whereas
Yes.
last year that was not the case as much, right? That's where the Magnificent Seven was coined. So, look, so my point, to answer your question, I don't think the future of the year depends on this NVIDIA earnings announcement. But man, if it comes in strong again and there's something, who knows, right? It could be another catalyst for a separate leg higher. You want to watch out for that.
Yeah.
I
I
want to be
mean,
aware of that.
I bring up the Apple thing because as an iPhone user, again, I'll just say it's serious garbage. It's not good. So it's, and their weather, I don't understand the severe thing. Like,
I mean, somebody's got to fix that algo. By the way, XLY, not so great compared. That's the one. That's the XLY is discretionary, right?
That's speedboats and lobster, discretionary stuff.
Well, stuff you would put on your credit card.
Mm-hmm.
Yeah.
Yeah. All right. I mean, it had gone up though. Jay, it's only been 2 months since its all-time high.
I'm just saying it's not there this week.
All right. That's fair enough.
If you look at staples, staples are, utilities are, financials are. What's XLK doing? I'm sure that's there because the NASDAQ hit an all-time high. Yes. XLK all-time high. Yeah, look, everything's participating. So there you go. This is it seems like the market has finally caught it. Remember everyone said, just imagine if everything else catches up to the Magnificent Seven. I think we're starting to see that.
Look at developed Europe too. EFA. That's, another all-time high. There you go. All right. So the other thing the market didn't like, and this is really funny. Well, it's funny because you and some other folks on our investment committee, I shouldn't say make fun of me for, when the CPI comes out or PPI, there's some discussion about it. And usually I wait because I'm off reading the PDF. And
you should know we do make fun of you.
No, it's true. I read the PDF, so you don't have to, Jay. That's right. And I remember, we just noticed. I mean, you guys noticed first before I did because I'm, buried in the PDF. But the market did not like that. And I think after a couple of minutes, I kind of messaged and said, "No, this is nothing. I'll bet you the market makes another high today." And the reason why I said that is because so first of all, was the PPI number really bad? Yeah, it was 0.6%, I think, 0.5 or 0.6% month over month. On a year over year basis, it's like, I don't know, it's a little bit north of 2%. So not too bad. But then I dig into the numbers. And one of the things you found was it was 3.9% was the month over month increase for portfolio management. Okay.
I didn't even know that was a category in there.
Oh, it is. And then goods, it was fuel. It was gasoline.
Okay, no surprise on that one. That one, everybody.
No. So, by the way, I had a funny one for you, Jay, in here. Oh, where is it? Something went down 18% month over month. Where is this, Jay? I know it's in here. I know you're waiting for it. It is. Let me see. So index for crude petroleum dropped 10.6%. Where is this? Natural gas, feed stuff. I think it was like unwashed fruits and vegetables or something. Maybe lettuce was down like 18%. I'm going to have to look at this, Jay. Now I'm very curious. So anyway, I look at this stuff and I'm like, all right, but here's the question. Was it the initial knee-jerk reaction to sell off in the markets because the analysts were wrong or because the number was wrong? And I think it's a case where the analyst, I think, thought it would go up 0.2%, and they got this one wrong. Is the number bad or just the analysts were bad?
No. Look, I think there's a lot of algo trading in the morning when those numbers come out, right? And for those that don't know what I'm talking about, the machines are trading. Yes. So they immediately interpret the data and try to get a jump on the move. And I think because the headline with Flash was like, whoa, PPI is higher than expected, not everybody, the algos weren't as smart as you to dig into the PDF right away, right? It took them a few minutes to figure it out, which you did. I think that was the initial move. So you always get that initial move, and then you get the follow-up from real volume afterwards. And it looked kind of like this might be nasty. And then you're right. You did call like, this doesn't look, guys, this is a weird blip. And you were right. And then the market closed at, the NASDAQ closed a new high that day, right? So
It did.
It all reversed there. So, yeah, like, look, sometimes the machines are wrong. They're too fast, right? Because you want that early jump. Sometimes they jump the wrong way.
By the way, fresh and dry vegetables fell 18.7%, Jay. There you go. So congratulations, fresh and dry vegetables. Not wet vegetables. I don't know what the difference is really between those two. Somebody can tell me. All right, enough of that. We got to talk about GameStop, though, Jay. We're an options-centric shop. Main thing we do is hedge, but we do other things around options. And for anybody who doesn't know, this roaring kitty, deep value, he reemerged apparently, or maybe it's someone who took over his account. I don't know. I don't really care, actually.
You saw the movie.
Don't watch that movie. So he tweets out a cryptic.
Yes, watch the movie.
Picture.
Watch the money movie. Yeah.
Don't watch the movie.
Yeah,
all right. So, and GameStop just jumps through the roof. So here's what I went and looked at, though. I went and I said, I wonder what the open interest was on the call side of the call options and what total call volume was. And I pulled up this chart, and it was just, I'll ask you what you make of it, and I can give my thoughts. But basically, for the listeners who can't see what we're looking at, total call open interest started to run up, as well as total call volume ahead of the move in the stock and ahead of the volume surge. So did people know that Deep Kitty, Roaring Kitty was going to tweet a picture ahead of time? Like, I don't know.
All right. Well, look, I don't know.
I'm smiling, by the way. We're being sarcastic.
I know you're smiling. Like, I know you're looking for a little inside baseball, or a little like, hey, there's a weirdness going on here. By the way, the data is absolutely strange to see that. By the way, it fired off on some of our screeners that, hey, volatility's on the move in GameStop, right? And it's something that we were watching. And so, and I even, got called out on my interview on Bloomberg. They ended up wanting to talk about something that we're doing that may or may not have had that stock in it. And so it's strange, though, to see that change. But the reaction to the stock, to me, of going up, what did it go up the first day? 50% and then 100% the next day or something like that. Like, some very, very, and now with, the fourth day it's down. It's very, it's not so much what was leading in and then the catalyst of what happened. It was that the market was poised to make this move. So, it's almost like the market was not only it wasn't even hiding it. Like, the spring was coiling, but you could see it coiling. You could see it building. You could see the volatility building up. You could see the option activity and how it was pushing up premiums and how people were willing to pay more for a call, 2 weeks ago than they were 2 months ago. And so I don't know if there was like, somebody knew what was coming, but the market was certainly getting ready for it. And then the short squeeze happened. I mean, it felt like a short squeeze to me. I mean, when you see that kind of a movement, that's people trying to get out of the way of the nonsense that was about to occur. It almost cracks me up to see that Wall Street even lets that happen. When I say Wall Street lets, like, there was nobody willing to take a bet against this thing as it was running, right? So really interesting stuff here, Derek, to be able to kind of read the tea leaves and see that, call premium and call volume and call open interest all on the rise, leading into that dramatic move higher.
Yeah. Yeah. And I don't know what to make of it, but it's sometimes, to me, this seems like the stock price, as I think you were alluding to, is the output from the input of somebody
just ended up being the result of all the people that had to kind of rearrange positions. Yeah, it's so weird. It's like, and I don't think anybody would have thought, oh, because Raging Kitty had tweeted a picture that all of a sudden, that would be the movement. It feels like the movement started and then just there was a cascade. Like that's what it just felt like. Oh, okay, get out of the way of all this.
Yeah. By the way, open interest or not open interest, short interest. I pulled this as well. And for the listeners, so short interest, I mean, there's different there's some firms I think that can try and do this real time and they look at a bunch of the data, but I just pulled up, it's about 2 weeks delayed, or at least at this point, I think it's every 2 weeks they release the short interest report. And so this would have been at the very end of April. The percent of float short, the float meaning, the available shares, about 24%. And I don't know. You know what's interesting though? Like who is shorting this at $10? Like what are you doing there?
If you think it's going to zero, you could short it at 10.
I know.
Not the trade I would place, but yeah.
But these what's the word? I was going to use the different word. The Wall Street bets crowd is always lurking on this stuff. Like, I hope if you're short, you buy a call option to hedge.
There, you should take a look at the other ones that popped on this too, right? AMC and the other meme stocks that just got the headlines, right? I mean, they didn't make our screener, but interesting though. To see too.
You know what though? I mean, Jay, this goes back to when you or I at TD Ameritrade back in the day. We hosted a webcast called the Option Huddle. And one of the things we did, we used to look at where the stock didn't necessarily move and options didn't necessarily, but you'd see this implied volatility spike. And then you would see, and I remember, one time it was a merger. I think, was it Busch Gardens or there was some merger and it was just random. And we were looking at it, we're like, what is this? And like, it just sometimes, people start trading the options on stuff, and the options market tells us what's coming.
Yeah, sometimes the tail can wag the dog, where the options market can force the underlying equity move, but it's got to be in something like this.
All right, I don't know what that guy's plan is. I don't know. Is he going to start giving trading advice, or I don't know? Good luck.
Let's get him on the show. Why don't you bring him on?
Yeah,
this is exactly his crowd. You love him.
I don't love Roaring Kitty. I mean, was he right, or did he just get enough people to buy the stock?
Who cares?
Yeah. All right. 90% of the time, though, Jay, we avoid recessions and stagflations, according to Bank of America and Haver Analytics and some other folks. So no surprise here. Like, this goes back to, most of the time the markets go up. We know they go down. We know they can go down by a lot, like in 2008, 2009. But I don't know, so basically what this is saying, and this is a scatter plot, if you're not in a recession and you're not in stagflation where CPI is above 5%, markets go up. No surprise here, Jay, but 90% of the time since 1948.
Why would you put this out of, like, it's like, hey, most of the time you don't, crash your car. Thank you for this information. You're like, okay, thanks, guys. Like, most of the time you're not running into something with your car, I guess, right? So what are we? Is this supposed to make us feel better or complacent that we're not in a recession or stagflationary environment right now? Is that what it is? Like,
no, I think it just reaffirms what you and I have been saying. That look, I mean, over time, we know markets generally go up. We don't know when that will happen. I mean, that's why we hedge. But like, this just shows us, like, 90% of the time, it's okay.
It's okay. Great.
It's okay.
90% of the time, we're okay.
Yeah. All right. Nothing else there. All right. Congratulations, market. So here's another one from Bank of America and some, I think, biggest. So what they're saying is they're looking at U.S. corporate bonds versus government bonds. And they're saying it's the biggest outperformance by corporate versus government bonds in the past 100 years. And I'm going to tell you why I hate this chart. For the audience, it's like basically it's saying U.S. corporate bonds have way outperformed government bonds by the highest amount going back to, what's this, 1924 or something like this. But what's missing on here is, sure, if you're looking at corporate bonds, which have durations, corporate bonds don't get issued normally for 30 years. So are you looking against, what's the weighting on this? 30-year bonds, 20-year bonds, 10-year bonds? Like against short-term treasuries, corporates have done worse. I don't know. I think I don't
Like,
like
what
this chart.
are we supposed to, like, all right, again, Bank of America, why did you put this out? Are we supposed to
Oh
think
boy.
that this is going to snap back? Like, why are you giving, like, usually when you have this, greatest move ever, is it supposed to be a reversion of the mean trade? It is a weird chart when you look at it, this pop that you've seen here. But again, I don't know what they're really measuring. I'm with you, Derek. I don't know what's being measured here, and what's outstanding. There's no level setting. All that being said, so what? What would you do? What would you do with this information? Is it now time to think government bonds are going to kind of help outperform, perform better against corporates, and this will revert to the mean? I don't know what we do with this back.
I mean, you buy duration in treasuries if you think the recession's coming and things are going to get really, really bad and they're going to lower rates. Like that's why you want that. If you're trying to make a directional trade versus or a spread trade against should I short corporates and buy governments? I don't know what you do with this. Good luck to the audience on this one, right?
Right. I don't know what to do with this one.
All right. Let's scare some people, Jay. You want to do that?
Yeah, because we just talked about how rosy it is. Let's scare some people.
Well, according to this is from a Bloomberg chart, U.S. New York Fed Equifax transition serious delinquency 90-plus days for credit cards, all age. All right. Basically 6.8% is the percent delinquent more than 90 days. And, this is higher than it's been going back all the way to, after the financial crisis. It kind of crested and then came back down, but it's the highest level we've seen since 2011. Of course, it was on the way down at that point. I don't know. I think this is something to watch.
Look, fine. Delinquency on credit cards, bad, especially where credit card rates are right now. Very bad, right? People could be paying mid 20% on credit cards. Mm-hmm. Don't be delinquent on your credit card payments, please. Please. It's the first thing you should pay off. All that being said, Derek, on this chart that you provided since 2000, we're kind of at the average. I know not the average maybe in years, but this seems to be in the average range. Of course, right after, all the government bailouts and all the help after the pandemic, you hit this really, really low era. And it did what it was supposed to do, right? People spent their spending and, delinquencies. What would be nice to see is the amount of dollars that were spent on credit cards versus the delinquencies, right? Mm-hmm. So I don't know that this is just a rate of what's outstanding. This looks to be kind of in the average. Yes, it's on the way up. Yeah, and it's hard to pay that debt. And so maybe, that could be pretty damaging, I would say, having to, like, that's debt it's so hard to get out from under, right? And so especially at the rates where it's at, I don't love it, but I'm not scared yet about this.
I think the thing is, I don't know if it's a level, but it seems like, the last 3 recessions, it was trending upwards. I don't know what to do with this data, but I just visually, when this trends upwards, you maybe see some recessions. I don't know, though. I don't know what happens here.
Okay.
All right, let's scare some people some more. U.S. Supercore, Jay. We've talked about this before. You you love it.
Inflation.
Mm-hmm. Yeah, we were too bullish. Let's scare people. So 4.91% is the Supercore, which is basically core services less housing, up 4.91% year over year. That is continuing to trend higher after it had come down. In 2022, it was above 6%. And if you're wondering, hey, what's going on there? Okay, well, the attribution of the contributions from Supercore, transportation services are a big part of that, medical expenses, and I think hospital care, everything there.
Derek, can you name something that's in transportation services?
Vehicle insurance.
Okay. I thought you were going to say shipping costs. It's your fave.
Well, sure. But I mean, we've talked about this before. I know we have a chart on motor vehicle insurance. I mean, what are we seeing there?
I mean, that's definitely been something people have been talking about. This is an interesting chart, right? Motor vehicle insurance looks like the year over year change has been on the increase since 2020. So it's been going up. And this is a crazy metric. It's up to over to like, what's that, 23%?
Mm-hmm.
1 year change. It's not like, oh, this is a number, it's up a little bit. Like this is the rate of change is 23%. That I know I have a teenager on my insurance. I just blame that. But
Mm-hmm.
wow, this is a big deal. You have a teenager soon or have? When's he driving? Soon. Too soon?
Three more years.
Yeah, all right. Start saving according to this chart. It's going to cost you double than what it costs now.
Yeah. Well, I'm going to have him ride the bike. Is it so? I think this
Careful that
isn't.
air quality. You don't
Yeah,
want
I
to happen
know.
with air quality.
Well, no, I'm telling him I'm sorry you can't drive today. It's severe weather. So, you know what? Okay, so I think you started to make the point here, and I'll hammer this home. These are year over year changes, which means you're up 15% from the prior year. You're up 20% from the prior year. You're up, it's not like you're stacking 20, 20, 20, but it's just like if this continues a year from now, are you going to pay 20% more or higher? And what do you think the cause of this is? I mean, it's got to be catch up because you don't renew your policy every month. So as the renewals come in, but those are all staggered, I imagine. Not
Do
everybody's.
you think it's because, it was so hard to get cars in 2020 and 2021, right? And so people
Yeah.
held their vehicles a little longer. And now, like you said, you're getting a new car and your rate is just higher. And you go, oh, I guess my rate's higher because it's a new car. I haven't been used to, the clunker rate. I've been used to the clunker of my old used car. I don't know, Derek. Maybe that's it. I can't, I'm not an insurance guy. We could have asked Buffett maybe at his shareholder
Could
meeting
have.
last week. He's a big
If you were
insurance
if
guy.
you were there too, you could have
Yeah.
asked him.
Well,
Yeah.
he and I go way back.
And if you had to go to if you got up to the microphone, you could ask
Yeah.
him. Yeah.
So, I think it has to do with that. Like, there's just a lot of, newer vehicles now. You could get vehicle. I say now, like the last few years, but wow, this is. I mean, I don't think it's. I mean, it'd be interesting to see, are accidents up? Are cars are they just worth more?
What about
Right?
labor? I mean, the cost to fix anything now after inflation. I think it's all sort of piling on.
It's kind of that circular Ouroboros thing where it just feeds on each other and grows, right? So
Yeah.
there's
This
your
is
reference.
This is something we talked about this several months ago, and it was kind of this lagging piece of inflation that's slower to change, slower to show up. But now that it is, it's not great. The other thing that's interesting too is a lot of these states, like isn't it California? They require you to have insurance, but the minimum insurance, like basically would pay for a headlight to get replaced if they hit, somebody hit somebody. It's like so minimal. That's the other problem. So insurance companies, like if you're an insurance company and the person is underinsured, potentially they could be on the hook for more. But all right.
Well, I can think of a story of someone I know who went to California, had a car accident with a rental car, and the people that hit him ran, and that was it. It was like no insurance here. Right? It's like, so guess what? When there's a lack of insurance because it's too expensive, those that can afford have to pay more.
Yeah.
Like healthcare. Like
Yeah.
All
right, let's get bullish again, or at least make people happy. The S&P 500 index milestones. This is from Charlie Bolello on Twitter. I don't know what you do with this, but it's kind of cool. And basically what he said was, what is the percent change between each 100-point increment milestone? So we just hit 5,300. It was 1.9% higher than 5,200. And so you kind of start to see, Jay, that as you go up, it takes less and less on a percentage basis to go from 5,300 to 54, 54 to 55. It took 56 days. It took 757 days to go from 4,800 to 4,900. And that was, that was January of 2024. So I don't really have anything to do with this, but I think it's an interesting way to look at sort of milestones and new highs.
Well, I mean, they always get the Dow hat. By the way, Dow broke 40,000 today. No, we never really talk about the Dow.
No.
Broke 40,000. That was nice, right? New hats, right? Remember they used to have a hat every 1,000. I don't look. Of course, it's easier to get these new milestones. Because 100 points on 5,200 is significantly smaller position than 100 points on 3,000. So I think this continues to shrink. I would say milestones are milestones. They always present interesting numbers where people might say, I got my sell order in at 5,500, and if it's so you want to get short. Derek, I think you'll continue to see the shrink, but it looks like this was a pretty quick period to go between 4,900 and 5,300, right?
Yeah.
15 days between a couple of these. So I wonder, on a percentage basis, just helps you understand how fast this move occurred. But we continue to hit these milestones, right? The market continues to go up over time. You didn't stop, right? You could have stopped for a little while here, but
can I just ask you too, so today I don't really watch CNBC. I'm sorry to say that, but I don't. And I do watch a little bit of Bloomberg, but I had the TV on and they had some guest on, and I was reminded, why I don't watch that. And they're like, oh, we could see 3 rate cuts now. I'm like, really? Like nothing changed. CPI came out as expected. That could mean 3 rate cuts. Like, stop already. Like, it's just the Fed did not decide, oh, great, CPI was on target, so now we'll lower three rate cuts. That's it. I just had a little rant there.
Well, when you look at some of this data, like the that we're talking about here, right? What's happening with
Supercore,
the insurance and the Supercore and medical expenses. I mean, there's an argument to be made they should be raising rates still, that they really haven't licked inflation, but I think they have to let it work through. I'm not a believer that they should raise. But by the way, now it looks like the most likely month for the first cut is September. It's a time you and I were talking about months and months ago. It doesn't mean we're right or anything, and who cares if we are. But this just feels like you're not going to get a lot of change in rates in the near term. But I'll go back to what I said a week or 2 weeks ago. At some point, it leans like the Fed will cut and the market will say, oh, rate cuts are coming. And if it doesn't happen in 2024, it'll happen in 2025, as long as we don't have a big recession or there's an event. And the market will like that. So I am happy for them to stretch this out as long as they can, because it feels like the market still looks for that first cut as a reason to go up.
All right, let's switch to a little option stuff. Let's talk about GME, GameStop. And I was looking, Jay, so we're recording this on Thursday the 16th this week. I'm looking at tomorrow's options, so the one to expire in 1 day. So by the time this is released on Sunday, you'll know how much the stock closes down or up tomorrow. So I'm looking at the 1 day options. It looks like the implied volatility is around 300%. So 300%. Yeah,
Wait,
it's
a reference.
Super high.
What is the S&P's volatility right now?
Oh, like if I looked at the SPX options
just look at the VIX, right? That's what the VIX represents. VIX got a 12 volatility. GME has over 300, almost 400.
Yeah, the at the money. I mean, the at the money S&P options for tomorrow is 8.3% volatility.
Oh, it's even less. It's 8.3
for tomorrow.
That's great.
Of course, because that's VIX is a 30-day estimate, and
yeah, that's right.
So basically, you take 300 divided by 15.875, which is the square root of 252, the number of trading days in the year, and it tells you what that converts the annual volatility number down to a day. So basically, Jay, it's saying tomorrow, 19% is the 1 day one standard deviation expected move for GME, GameStop. So stock
Well, and
closed.
by the way, let's say you wanted to buy the straddle. So let's talk
Yeah.
about a tactic you do with this information, right?
Yeah. And don't do
So
any of this, please. Like,
no, you
yeah.
wouldn't. But so, like, just telling you how the market is pricing this in. So
Yeah.
buying the straddle means you're buying a call and buying a put at the same strike. Usually, that's done right near the one closest to the money. So GameStop's at 27.6. Let's look at the 28s.
Do the strangle, Jay. Strangle means buy the
Oh,
28
strangle
and the
is where you just
27.
yeah, you
Yeah.
go a little farther out, so they're not the exact same strike. So straddle is more like a V. Strangle is a little wider. I always think of like if I was choking somebody, my hands are a little wider. That
Yeah.
doesn't sound nice at all, but that's what it's called, strangle of straddle. If you wanted to buy the straddle, it would cost you $5.40. So what that means is if you bought that today, let's do a little math on this, $5.40 divided by, what did I say, 27.67. The market, GME would have to move 19% in either direction for you to break even at the close. That's what's priced in. By the way,
Yep.
you don't have to buy that straddle. You can also be on the other side of that trade.
Don't
and
do that.
Sell
Don't do
that straddle.
No, don't even bring it up.
Go naked a call or naked the naked the call and the naked the put on GameStop. Which, by the way, it's probably going to be held at an extremely high margin rate. And as long as GameStop doesn't move 19%, then that'll make money. By the way, today it moved 30%, right?
Yeah.
So if you made that bet yesterday, you would lose today if there was the same pricing. So just interesting to see the options are highly, highly inflated, high premium, high volatility. This is what's implied in the move. So while Derek gave you the standard deviation and implied number, there's also a way to cheat. Just look what the at the money straddle costs you. That tells you what the options market is projecting the break even to be.
Yeah, literally, if you bought that, the market could move 19% and you would still lose money.
Yes.
That's
If you held it till expiration, you didn't trade out of it.
Yeah. You know, we always joke around, don't try this at home. Really, don't. Like, go watch a game show. Don't trade GameStop one-day options. I will bring up something else, and this is, yeah, I'll bring it up. With volatility this high, you know, normally we would say, you know, define risk trades would be buying, let's say, a put spread or a call spread, or selling a call spread, selling a put spread. Define risk meaning, you know, the distance between the strike prices there. What's so interesting here is you really can't put a spread on this because the volatility is so high. And I think I know, you know, where I'm going with this. Like, let's say you're like, oh, there's no way it's going to $60 tomorrow. Okay. But if you tried to, you know, sell a 60 call against a 70 call, you're talking pennies, because at some point the dollar amount of each of the options is sort of equal as you go up and up the chain in these blocks. It's a little different. Maybe that's a little too technical for this podcast, but
well, let's see. The 100% up from here is strike of 54, right?
Yeah.
So, yeah, look, I would, and that's trading at, let's say, 30 cents right now. So it's as of the close. So it's one of those things that, yeah, like there's premium all the way out there, but there's no obvious spot where it really dissipates, right? So, you know, you want to put a flyer on, Derek, and say, like, maybe it doubles tomorrow. You buy the 54 for 30 cents, cost you $30 a contract. And if it doubles tomorrow, you still won't make money. It needs to go up more than that. So, but look, I think you trade that one at the gap, right? You buy it at the close, you sell it at the open, kind of a deal. If it goes your way, you take it. It's just one of those trading tactics. If you get a gift on a bet like that, it's you know,
most of these are not worth it.
But the probability of that is zero, yet it still would cost you $3.
Yeah.
Yeah.
Don't do these. Go find like the Bob Barker Price is Right reruns. You'll get a much better return on your investment there than you will.
It'll be fun. Come on, it's fun.
Yeah. By the way, what's NVIDIA? NVIDIA, do we say what the earnings date is? Is that May 22nd?
Yep. We talked.
Okay. So the options there are the May 24th, I guess we could look at.
Sure.
And I was surprised that the at the money Again, this one's 943 and change, so right between the 940s and 945s. But the around the money implied volatility is 73. 73. So what's the implied there? 73. Yeah, I'm going to cheat. Do the rule of 16. 4.5%. The 1 day, and this is 8 days. So square root of 8 times, what did I say? 4 point something percent.
4.5.
Yeah. So it's like a one standard deviation, 12.5% ish move by the options market. That seems low actually to me.
I think it is too. I think
Yeah.
it's low as well. Yeah, I mean, you're going to spend about to buy that again. Let's do my cheat. You're going to spend about $90
Mm-hmm.
to buy the straddle, the 945 straddle, which at 943, $90 is just under 10%. So, there it is. It's an implied move of you're in this 10% range for Nvidia. Maybe you go like, oh, there's a good chance it can move 10%. There you go, up or down. Who knows? That's what the market will charge you to make that to do that 1 week trade. It's bouncing right up against the all time high. Interesting. It's an interesting trade. But like you said, I would probably spread that out, right? I would cut that down a little bit. Where can I get 5%? By spread that out, I'm sorry, I'm meaning buy these and then sell leg into a spread. So buy a call spread, buy a put spread. That's a more affordable way. You don't want to, you're paying for the chance that it goes to 1,200 and paying for the chance it goes to 700 when you just buy the straddle. Those are things you probably don't think are so likely. So you could sell that away, right? So you get a little income by selling those out, right? So I just told you it was $90 to buy that. Actually doesn't pay to sell the 700, but if you wanted to cut the price down a little bit, let's say you sell the 800s, those are $3. So that means you're like, hey, I don't think it'll go below 800, and the 1,000, I don't think it'll go above. Sorry, not 1,000, 1,100, which is a pretty decent move on the way up. It's another 15, 16. So that's another $5 or $6. So you could cut down your break even a little bit by selling those, 15% moves, right? Because you don't think it's going to move that much. By the way, the market doesn't think it's going to move that much much well, right? 10, 11 delta on those. So low probability that you get a 15% move. There you go.
All right. I'm going to take a listener question this week. Thank you guys for being so helpful. Thank you. This is from Andres. He said, look, if we want to talk about covered calls, Jay. So,
we like covered calls.
Yeah. So owning a stock where you sell a call above the current price of the stock, and it's covered because if you get assigned on the call, we have the shares. So his question is, let's say I'm selling a covered call. It's an example. He's got a $5 stock. Okay. It's a little bit low price, but we'll work with it, right? And I sell the $10 call. And let's see here. Well, first of all, his question is, can it get called away even if it never reaches 10? And can he be exercised before the stock reaches the target? On the second one, yes. If it's an American style option, which most equity options are, you can be assigned at any time up to and through expiration. Index options or broad indexes are generally cash settled, which means, cash settled, and there's no early
European
assignment.
style.
Yeah, European style. But yeah, maybe we just broadly just think about, okay, when would you get called away early? And even when it goes in the money, meaning it goes above, your stock price is above that short call, when do you get called away? Like, that's a question we get a lot, Jay.
Okay, so look, let's first talk about if this makes sense. So you're right. When you, in this scenario, you're long at 5 and you sell the 10 strike, can you get called away if it goes up to $8? You could be, and if that happens,
It's a mistake.
You should be celebrating because you just got a free $2,
Yeah.
right? The stock's trading at 8, but you got to sell it at 10. Like, think about what that means, right? Remember the dynamics. If I told you, Derek, the stock is trading at 8, and I just said, hey, you okay if I take it away at 10 while it's trading at 8? You would say, yes, please give me my $10 while it's trading at 8. Like, that's so the person who's long the call is very unlikely to call it away from you like extremely unlikely to call it away from you it's at 8 410. So if it happens, it's a gift. It would be a mistake whoever did the calling away. So I would say you really shouldn't expect that to happen, right? Generally, out of the money options don't get early assigned, right? And even if they knew something was coming, like let's say you knew Roaring Kitty was going to post, right? They
Oh boy.
still wouldn't give you $10 for an $8 stock. You know why? Because their long call would go up just like the stock would, right? You're short, they're long. They would participate in the growth. It's not like, oh, I think it's going to go up, I want to own the stock. It's like, oh, I think it's going to go up. Hold on to your call. The call's a better deal anyway. They're not going to exercise that. So I don't think never say never because there's always a chance. But that's really not going to happen where you get called away when it's at 8 and they give you 10. All right, that's first part of the question. And what was the other part of the question?
Well, let's say a stock goes in the money. So this is it can be a common thing. So somebody owns stock.
Now the stock's 12 and you're short the 10 call. Sure.
Yeah, and let's say you have all right, so I guess there's a difference too. Is it 6 months away or is it 3 days away? And yeah, some things to consider here.
Yes. Okay. So you're definitely at risk of having it called away. But like Derek just said, there might be a lot more time. So let's remember what happens when you sell the call, right? Let's say you sold this call for 50 cents, the $10 call. You're long at $5. You sold the $10 call for 50 cents. You're 6 months out. Well, now you're a month out and the stock is trading at 12. If you are the person, so there's at least $2 value in that call. We call that intrinsic, right? The call's at least worth $2 because, hey, I get to buy at 10. This is the person who owns the call. I get to buy at 10 while the stock is trading at 12. That thing has at least $2 of intrinsic value. There's this value of $2, right? So as the short seller, which you are as the covered call person, you're going to owe at least $2. However, when the person who owns the call exercises, Derek, what happens to the call? Not the stock. What happens to that call when you exercise that call is worth $2? Let's say it's worth $2.50 or $2.25 at the time. That call is worth $2.25. What happens to that value when you exercise the call? Where's the call go when you exercise it?
Goes away. You lose that value.
Yeah. It's gone. So yes, you get the long stock, but that call that was worth more than $2 is now gone. So as an option trader, this is why we pay attention to the time value the long holder is giving up. So you could either own the stock at 12. You own the stock at 10 while it's trading at 12. Great, $2 gain as this call exerciser. But you've just lost the value of the call, which is going to be more than $2. It might be $2.25, right? Because there's still time value. There's still volatility. That's all still baked in there. That call is not trading exactly at $2. If the call was trading at exactly $2, you absolutely should expect them to call it away, right? They have no reason to hold their call anymore. They're fine giving up the $2 of the value of the call. They're getting the stock at 10 while it's trading at 12. They have the $2 gain. That's worth it. But if that call has all this time and extrinsic value, let's say it's trading at $3 or $4, why would they give up a $3 call to have a stock that only has a $2 gain? So watch the time value, watch the extrinsic value. Yes, we know it's in the money. We have some clients right now that have sold calls on NVIDIA. They sold calls on NVIDIA when it was trading at $800. They had the 850s. Those calls are in the money by quite a bit. But you know what? The holder of the call is not exercising because there's also $15 of time value in that call. They would be giving up $15 by exercising early. So they're going to hold on to that position. They're not just going to give away this $15 of time value.
Or if they want to sell it, they're not going to exercise, get the 100 shares and sell the shares. You're just going to sell the option.
Done with that position, like, whoo, I had a good run in this NVIDIA call. Yeah. It's made money. Of course, you'd want to sell that call with the extra $15 of premium in it versus getting the stock and selling it and not having that 15. So the whole trick of watching in the money calls this applies to the money puts too, but dividends have a bigger impact, is look at the extrinsic value. Think to yourself, now are they willing to give up that extrinsic value, that extra premium they have in the call to take the stock away from me? And generally the answer is no. Can it happen? Yes. And look, you need to be prepared for that when that happens, right? That can happen. It's rare, but it can. But watch extrinsic. Extrinsic is your guide. If there's a lot of juice, option juice left, the chances of it getting called away are less.
Yeah, no, I like that explanation. And then I'll just add, and we can talk about this too. If you have a stock that pays a dividend, generally, if the dividend is greater than the amount of extrinsic, i.e., time value, there is a chance your stock will get called away early. Jay, right? I mean, because they want the shares to get the dividend if the dividend's greater than the extrinsic. It's not a certainty, not 100% you get called away, but there is a likelihood.
Yeah, call sellers. Every call seller that I know that's been doing it for a while all learned this lesson the hard way. Like, oh, look, there's all this premium and the dividends coming up. Great. As soon as you buy it, you get assigned and you lose the stock. Why? And Derek's right. They want the dividend, but actually, what's even more important is they don't lose the value in the call by the dividend.
Right.
Derek, if stock's trading at 100 and it has a $2 dividend, what is the stock priced at the next day?
98.
98, right? With all things being equal. So if I had the 80 call that was worth $20, what happens the day after the dividend? What's it do?
Goes down.
It goes down by $2. Did you get a dividend?
No.
So what happens is the long call holders have to get out of it. So either they trade out of it, but maybe they can't trade because there's, like you said, extra juice in there. Instead, they assign it, take the shares, and then get the dividend to offset what their extrinsic values that they would have lost by selling it. This is a complicated concept, but watch for dividends, deep in the money calls, around distributions, around dividends, can get assigned early. They can get assigned early because the long call holder doesn't want to take the ding from the drop in price of the stock without getting the dividend. It's a complicated concept, but that can be an early trigger. You may be like, I don't know, there was extrinsic left. What happened? Jay, you said there was $2 of extrinsic. He's not going to take it. Yeah, there's a $3 dividend, so they're going to take it in that scenario. They'll take the stock away from you because they don't want to lose $3 on their call tomorrow. They'd rather own the stock and get the dividend and break even versus take the drop by the $3 dividend. You have to think of the logic on the person on the other side of your trade.
All right. Well, thanks for the question. Yeah. And by the way, Derek.Moore@ZEGAFinancial.com. Z is in zebra, E is in Eddie, G is in George, A is in Apple. Financials up to you to get right. .com. Send me emails. We like emails. And we'll try and take some questions. All right, Jay, any recommendations this week?
Oh, boy. I've told you I was watching Doctor Who's. I like them. I've seen the first few. That's great. Disney Plus has that going. I have not watched Dark Matter yet. I'm letting it queue up. I've only heard good things from other folks that have watched it. I know you read the book there, so you're watching that one. I am halfway through. I'm only halfway through because it's 3 hours long. The Roast of Tom Brady on Netflix.
Oh boy.
As you would expect, a roast that's, a little raunchy humor. So I'm not recommending it for everybody, but it's long. It's 3+ hours long. I was like, it's going to be 40 minutes. I'll put this thing on. 40 minutes in, it's not over. It's not even halfway. So I'm like an hour and a half through that. And I'm not the biggest Tom Brady fan as a football fan, but as a, as someone to watch someone that had such an amazing career, of course, you want to watch what they have to say about him. But I will give you one highlight if you've watched it. And as a Giants fan, I appreciated this. As you know, the Giants foiled the Patriots' potential perfect season in the Super Bowl in 2008, which, Derek, you and I happened to both be. Not together. Yep. We were both there.
Yep.
Ron Burgundy So Will Ferrell's character, Ron Burgundy, comes out and roasts him, and he makes everybody chant how Eli Manning, controls Tom Brady. I will not use the exact language used. So I love it that Eli got some, and the Giants got some attention in Tom Brady's roast. It was obviously necessary because there you go. But that's it. So I would say I'm halfway through. I don't know how it ends yet.
Does Bill Belichick wind up coaching the Giants next year?
Oh my gosh. Look, he was I don't know if everybody knows this. He was the defensive coordinator for the Giants and won 2 Super Bowls.
Comes back home where it all started, where he belonged. Yeah. He should have never left after Belichick, after Parcells left.
After Parcells left? Yeah, I don't think so. I think they like Dable there at the Giants.
If they don't have a good season.
They won't.
I'm just saying.
They won't. You don't let one of the best running backs go to Philadelphia. Like, what the heck, Giants? Let's not start there. You don't let Saquon go. How do you let Saquon go? What the heck? I can't even talk about it. Sorry. Now I'm not recommending the Giants.
I think Bill Belichick could wind up being our coach. I'm just saying it. I think that's it. Comes home, Jay.
So many years left in him. Okay.
Do we want to win or not? He's kind of won a lot.
He has won a lot. He absolutely has won a lot.
All right. I don't think I have any recommend. I will tell you that I read the book and I reminded once again that if you read a book and it's a really good book, the movie or series is not as good. I think Dark Matter is very good. If you read the book though, you're going to be like, "Ooh, this stuff is happening really fast." And so I don't know. Like, I know it's coming. That's the other thing. But I think it's good. I think people will enjoy it. It's a good premise, and I think it's an interesting premise. So there you go. There you go, John.
All right. Well, I watched the second Rebel Moon on that Netflix as well. Not as good as the first one.
Rebel Moon. Okay.
Rebel Moon. It's supposed to be like a nice, Star Wars-ish thing. And yeah, second one, meh.
I'm not familiar with this one.
It's okay.
Part of okay. I just looked it up. I'll put that on the list.
The first one was pretty good, right? And they released it. It's just Netflix only movie, and first one's pretty good. Second one, I don't know. There's a third, by the way. So maybe.
Do you know Netflix is getting NFL football this year?
No, I didn't know that.
I think NFL. I think the Christmas Day games are going to be on Netflix. Yeah, they paid $150 million for the 2 Christmas Day games.
NFL schedule's out now, so now
it is.
You can see what's going on there.
So yeah, Steelers, Chiefs, Ravens, Texans on. I got to be honest with you. Like last year, I'm like, really? Do I need Peacock to watch the playoffs? Like, come on.
Oh yeah.
What are we doing here? All right, that's it, Jay. I think I'm done. You done?
I'm done, Derek.
All right. See everyone. Take care. Bye.